to this governor talks. This time around, we will have Governor Santiago Bausili from Argentina. Probably this will be the most popular governor talk in quite some time at the fund, no? So let me give you a very brief introduction of Governor Santiago Bausili. He has a degree in economics from Universidad San Andrés. He worked extensively in markets at JP Morgan and at Deutsche. He also had some experience in a previous administration in 2017 in the Ministry of Finance. And in the last few years, he had a consultancy, Anker is the name, where he was partner with the current Minister Caputo. So of any questions that you may have, one is very easy. Coordination between the Ministry of Finance and the central bank probably is the best you can see ever. So welcome.
Thank you very much.
Governor, the idea is that I will ask Santiago a few questions. Towards the end, we'll have the possibility to open up for questions from the audience. No? So let me start from the beginning of this administration. You inherited a situation that was super tricky, a lot of imbalances. You came with a plan. What you would say are the key building blocks of that plan?
Okay, so I'm going to talk, of course, from the perspective of the central bank, so monetary and FX in particular.
I think, sorry for the introduction, but I guess you should recognize that it's very different, that challenge, with a fiscal that is out of whack or yes, one that is...
Yes, of course. So from the get-go, we had the view that there was no more room for fiscal imbalances because Argentina had run out of financing possibilities. So you can only have the fiscal deficit that you can finance, not the one that you want. And you have basically two sources of financing: debt, which Argentina had run out of, both international market and domestic market were already capped out, and monetary. Actually, during 2023, there was no net financing from the domestic market either. It was all monetary financing. And the monetary financing had reached a point where the risk of hyperinflation was too high. You were already at that point where you don't know where the next step is spiraling out of control, or maybe you have one more round, but the risk was too high. So from that perspective, the fiscal, in a way, was a given. It is always challenging to implement it, but that was a basic assumption behind the monetary and the effects ideas we had been thinking. And to tackle the effects and monetary imbalances, we took a very basic approach of trying to separate flows and stock imbalances in both monetary and FX. So on the monetary front, you had a flow imbalance associated with or linked to the idea that the central bank was printing money constantly for two reasons: to finance the treasury and to pay interest on its own liabilities. That was a flow imbalance, and that issuance was larger than what society was willing to take. So, and that generated a stock imbalance, which is linked to all those years of an accumulated flow imbalance resulted in sterilization efforts that, in our view, had already reached a limit also. Society is willing to provide, has a certain appetite for a sterilization instrument that also has a limit. You cannot sterilize as much as you want. You can only sterilize as much as society is willing to take. So we took the view that both of them had also reached a limit, which means that when you reach that limit, if you force it a little bit, you might spiral into hyperinflation. You can see this by the monetization in real terms, so the monetary aggregates relative to GDP. The monetary base in Argentina touched a minimum of around 2.5 points of GDP in March, April of 2024, which came with the lag of the 2023 imbalances. And Argentina historically has functioned with a monetary base of around 8 to 9 points of GDP. So this was the only point in time where you saw this level of monetization was in the context of a hyperinflation in the 76 or 89 crisis. So we were very concerned about fueling that imbalance further. And that, of course, is linked to the FX imbalance, which also we took the view, we made the analysis separating flows and stocks. Flows in terms of how much FX the economy was demanding to function, to have at least a minimum functioning capacity, and how much that flow imbalance had accumulated a stock imbalance. And the stock imbalance was mainly associated with capital control, so how much was held up or stuck in Argentina of portfolios that wanted to leave, but also, which was very peculiar in that instance, was the imbalance linked to trade debt, to how much was approved to come in through imports, but had not been paid for. And that was the most challenging one, because we had reached a point where that had been abused to a degree that the economy was at risk of running into a halt. Because if you run out of supplier financing, then a producer in Argentina that needs an intermediate import good to keep the wheel turning may need to stop operations. And that, in terms of economic activity, was extremely dangerous. So we attacked these two in parallel ways and at the same time. The flows, in terms of effects, we implemented a calendar. So exporters had to bring the effects immediately into the country. Importers had only access through a calendarization for monthly installments that at least, they were not immediate, but at least they were predictable. You had visibility, so that we hoped that would allow companies to make business decisions and to keep the wheel turning. At the same time, we provided an exit for stocks, the imbalances associated with trade debt through a security issued by the central bank that allowed us to sterilize pesos in a different fashion than the traditional one by providing a dollar-denominated security to attack those stocks. And on the monetary front, we faced a very interesting challenge, because the debate was, what do you do? How do you make this currency relatively attractive, or improve the attractiveness of this currency that society has been running from for all this time? And the traditional way is you raise interest rates and you tell people, hold on to this currency because you're going to be wealthier at the end of the cycle. You're going to collect an interest on it, and that's going to be better. But we knew that people had to pick their venom, as they say. So you either have more supply because of the interest I'm paying you, but you're making money on the interest, or we can make the currency more attractive by making it scarce. So that was the dilemma. And we picked the second route. So we took a very aggressive view of bringing interest rates to a negative territory in real terms, which was risky, but we banked on the fact that we had strong capital controls in place. And we figured that the scarcity proposition was going to be more attractive than the interest compensation proposition, because that one had already been played too much, and the supply factor was worse than the scarcity factor. So we reduced monetary balances in real terms through the negative interest rates that were only available because of the strict capital controls, and by adjusting the FX rate, people shifted the way they looked at the currency and started looking at interest rate as an FX parity decision rather than a purely in real terms decision. So that's how we tackle that problem. And with that problem at least funneled into a solution situation, nominality started coming down, and inflation started coming down, and real balances started becoming more normal, and the imbalances in these markets started coming down and normalizing. And that allowed us to move forward in the next phases of the program.
Let me jump forward to the current phase. Last Friday, a few days ago, it was announced a very important overhaul of the structure, of the macro policy framework. Can you elaborate a bit more now on the new effects and monetary policy framework? And a very specific question is, you used to have many different exchange rates. There are fewer now. Perhaps the question is, how much is fair to expect in terms of convergence of different exchange rates?
So as you said, we call this phase 3. This is like the iPhone, right? There's a new phase every cycle. There's a new phase, and we call it phase 3. And this is phases because we look at this with a single objective, which is ultimately becoming a normal economy, where we picked the currency competition framework because we acknowledge the fact that Argentina is a bimonetary economy where people have already decided that they save in dollars, they use the dollar as a unit of account for long-term assets, for real estate, for cars, for wealth calculations, but they use local currency for transactional purposes. So that we decided not to fight against that. That is a reality. That is what society is doing, whether we like it or not. So we'd rather adapt policies and the economic framework to what is already in place versus trying to change their mindset or think that we can change their mindset. So with that ultimate objective, what we're going through is the different phases down a path that should take us there. And that path has to do with the starting point and the ending point, and which layers of controls, restrictions, regulations we can get rid of that will ultimately take us there. So we started off with a crawling peg, fixed exchange rate regime, strict regulations in place that basically generated, of course, parallel markets and multiple currency practices and effectively multiple prices for the same asset, which is FX. And as we move forward and we're able to get rid of some of these layers, those gaps start, we start getting rid of them, and there's convergence in terms of the different prices for the single asset. So right now, we moved away from the fixed crawling peg to a free float within bands, with the idea that we want to eventually move to a free float regime, but because of the bimonetary nature of this economy, and because it's been a very long period of time during which Argentines have become used to having the effects as the nominal anchor of the economy, we'd rather move into this free float regime with certain containment. So that's the role of the bands. And these bands, they have a crawling rate to them. So the upper band is moving up at a pace of 1% per month, and the lower band is moving downwards at a pace of 1% per month. So the idea of that is that we avoid the question, when are you going to free float? So it's going to come in time. There's no further phase in terms of the free float. There's no further stage that becomes a source of anxiety and of bets of when is the next regime change. You will naturally go into free float because the banks, continuously broaden. At some point, they become relevant. The reduction or elimination of the FX gap has to do with FX restrictions. We still have restrictions in place because we still have stock imbalances. We're comfortable that the flows are already well balanced both in the monetary market and the FX market. So much that there's no FX gap, there's virtually no FX gap. I'll talk about the existing FX gap in a second. And this changing in regime, this moving from phase 2 to phase 3, did not come with a sharp move in financial variables. So that's evidence of balances in the flows. Now, certain stock imbalances remain in place, mainly associated with multinational demand for portfolio shifts linked to dividends that have been held up during the 4 or 5 years of controls and a portion of intercompany debt. So while those imbalances remain in place, we need to keep certain restrictions in place so that we can continue moving this direction of eventually liberating them and freeing them up. Now, as this is very well contained in that group of economic agents, of players in the economy, the rest of the agents are free to move, in particular individuals. So as long as you have one group that can move between the different markets and not be subject to any type of restrictions, then that group should be able to arbitrage the different prices for the FX, and you should get rid of the FX gap. You will always have some level of FX gap associated with transaction cost. In time, it may be reduced, it may be larger or smaller, but effectively, it's zero, meaning you cannot really arbitrage it beyond what it is.
Let me ask you a bit about the recent experience from your personal perspective. In these processes, there are moments of high tension. Some things that from the outside world we think were super difficult, actually everybody in the team thought the same, no problem, and other things that are transparent for us were a source of heated debates, or even perhaps with the IMF team. So can you tell us about examples of those two things?
I like the concept of the outside world. So we're in the inside world. So in this experience, the last year and a half, there's a tremendous amount of asymmetry in two senses. One, in terms of information, availability of information. When you sit at the government, you have a grasp of what's going on in the economy that is much more detailed and much better than if you're sitting in any of the other positions, because the whole economy gravitates towards the government. So you have access to all these sources of information that none of them have by design. So that's one difference. The second one is the starting position of Argentina is so complex. There's so many layers of regulations and distortions in place that it's probably impossible for anybody to understand them completely, irrespective of which position you stand. But then you have degrees of comprehension, of understanding of these layers of complexities. And what I tried to do here is, Argentines are not special. They're not different. They're economic agents that just like anywhere in the world. They react to economic incentives, to financial incentives. But the starting position is different. It's the layers of complexities. So we have a joke that we say when you start pulling out of this regulation, it's like you pull out of this string and suddenly your leg pulls. And you didn't realize that it was going to end up there. So the combination of these two things results in the surprise factor that you feel, that you sense. And that makes it asymmetric. So most of the times when we took a step towards this normalization process. We did it when we had already a certain degree of confidence that a step forward was not going to mean 2 steps back. And so far, it has played that way. We started out designing the program with a very strong assumption, which is we have 0 credibility. Argentina has run out of credibility. It doesn't matter who is in office, who designed the program, who is saying what, 0 credibility. And credibility is an extremely powerful policy tool that most governments enjoy, but we don't have that benefit. So if you have no credibility, as I said, you should only take a step forward once you're extremely comfortable that there's always going to be a risk involved, but that you've mitigated as much as you can that risk. So most of the times, what surprised the market was not what surprised us, and we were more concerned about something that the market was not envisioning that sometimes materialized and sometimes didn't. This last example was a great one. I think that I get the sense, talking to investors these couple of days, that we have very little participation of foreign investors in the domestic market or in the international market. And because of the situation being so complex and so different from other situations in the world, people have not really taken the time to understand the details of what's going on. So you see a change in regime being announced, fixed peg to crawling bands, and you immediately think, okay, the market is going to test the upper bound. And a large number of people expected that because they were not familiar with the technical position of the FX market as we went into the changing regime. So for us, it didn't come to a surprise that the top end of the band was not tested, but for most people it was. So our concern was never there. So that's an example of a surprise factor.
Very clear. One last question from myself, and then we will open. Thinking now future, medium to long run, with the band growing and growing, how you think, what are the next challenges in terms of anchoring, in terms of basically the role of the central bank in that world? It's obvious that it's too early in the game to be very precise on that, but perhaps the questions that you have for the future.
So I think that I see 2 challenges that have to do with behavior, how people will adapt. So one, purely from a monetary perspective, we're moving away from the effects being the nominal anchor to, in our case, monetary aggregates. And it's a question how fast people will incorporate that and will adapt to that and will incorporate that in their day-to-day decision-making process. We had a very short and very simple example the last couple of weeks. Because of our legal framework, we had to get congressional approval before we entered the IMF program, and that made it clear to everybody that there was a risk of a potential regime change, and that triggered hedging decisions. And hedging decisions come through financial markets or through the real market, people adjusting prices of the goods just in case. And then the regime change came with, and the risks of jumps in financial variables didn't materialize. So what do? Do you undo the hedges? Did you lose money in that hedge? Did you, how do you unwind that? And how does that affect your behavior going forward? Because in the real economy, and that's the second challenge, it's been for a long period of time, for Argentine businesses, it's been a better economic proposition to hold on to inventory than to grow your business. Because in a context of negative interest rates in real terms, where you have cheap access to financing and high nominality and high uncertainty, holding on to goods was a better business proposition. Now, in the current context, I sense you're better off rotating your inventory, selling, and enjoying the financial benefit of a normalized world. But that means that you have to be willing to reduce margins. It's a different business proposition, business model. And so agents will need to adapt. So you see some industries that adapt faster, like we're looking at, we're seeing the automotive industry. Sales, car sales in, what was it, February, I think we're up like 50% year over year. So those guys are adapting, and they're selling in interest-free installments, 24 interest-free installments, and they're moving inventory. But some other products are not doing that. And that generates a distortion in relative prices, because people that don't adapt have higher prices than what they should. So there's a relative price distortion. And it generates a distortion in terms of how balanced the economic recovery is. So I think those are two challenges.
Let me open now to our audience in case they would like to ask anything. What we will do is to hear 2 or 3 questions, and the governor will have the luxury to choose which one to answer. None? That's a very shy audience.
So I
Yeah.
cannot get to choose then.
No, we will have one, another one. If you can introduce yourself. But
okay, I'll introduce myself. I'm Ksenia Yudaeva, the Russian Executive Director. So thank you very much for a very interesting presentation. As a former central bank, I have a question about your monetary policy, and there is one thing which I struggle to understand. You've just said that your interest rates are negative, but you make money scarce. When you make something scarce, its price should go up, meaning interest rates should go up. So do I understand you correctly that your market interest rates are actually high, but the central bank stabilization interest rates are low? Or how does it all work? Because otherwise, sort of different pieces do not match together in my mind.
So the floor is open still to have some optionality here.
I can start.
Okay, let's start with this. We have 2 minutes to go, so probably it will be the only one. So
can you, yeah, it is back on. So what I mentioned is that at the beginning of the program, at the stabilization program, we imposed very negative interest rate in real terms. But then what happened is, as inflation started coming down, those interest rates became positive in real terms. So the convergence towards positive interest rates in real terms was through inflation coming down rather than the central bank raising interest rates. To give you a sense of market available rates, 3-year Treasury paper was yielding minus 13% a year and a half ago in real terms. So this is inflation linker, sorry. And today they're yielding 6-7%. We had that tremendous swing in the sign of real interest rates. Fortunately, the financial system is strong enough that it didn't suffer because of that. That was a huge repricing of asset values, but still it was able to withstand it quite fairly. And we got the benefit of a more normalized financial market conditions, becoming more attractive in terms of return on interest rates, on currency. And through this process, we've been moving away from using the interest rate, the central bank policy rate, as the main monetary tool, and moving towards monetary aggregates where interest rates become more endogenous.
Thank you, Governor. This is coming to an end. It's very interesting, the question by the Executive Director, because we're part of the discussion the last year and a half with the fund team, and was a contentious discussion. So thank you, congratulations for the very good start of phase 3 of your program. Hope that everything goes very well. Thank you.